Okay, throughout the next couple of weeks, we're going to be following and exploring the Walt Disney Company, or another company if the instructor so decides. But we're going to be looking at their annual report and working through the data trying to find information. So when we're done, hopefully you have an understanding of what financial statements are all about. You know where to find the information. And of course, by the end of the class, it's hopeful that you'll have a basic understanding of how this information is used to make decisions for the company. So, annual reports contain 3 basic financial statements and then an additional statement for some clarification, if you will. There's a balance sheet that talks about financial position. There's an income statement that reflects operations outcomes. There is a statement of cash flows that talks about the cash position of the company. The decisions that have been made throughout the year is broken down into some component parts. Of course, we'll talk about those. And then in the end, there is something referred to as the statement of stockholder equity that just better describes the owner's position in the company itself. So again, let's think about a balance sheet. A balance sheet tells us about the financial position of the company on a particular date. It's going to illustrate or point out the totals for the different kinds of assets, liabilities, the stockholders' equity. So if we look at a financial statement, here's a balance sheet. This is Molson Coors. And if you look at, we can identify what are referred to as line items, right? Cash and marketable securities for 2004 is 123, these are in millions of dollars, $123 million. The total account current assets is $1,268 million. So again, as you can see, it's broken down into assets, and then down here is liability and equity. A very simple way to think about financial statements. The assets of a company reflect the things that have been purchased or acquired by the company to do the business that they're in. This is where operations happens. This is where the cash flows of the company are created. In the end, this is also where the value of the company comes from. The other side of the balance sheet merely reflects the financing. Where did the company get the money to buy the assets? So the assets represent the things we've purchased. The liabilities and equity section demonstrate where the assets, where the cash came from to buy those assets. Now, when you think about the income statement, then, it is a statement that reflects what happened throughout the year from running the business. So in this case, in 2004, there was $4,305 million in net sales. The company spent $2,741 million on producing products, which meant after those expenses, the gross profit of the company, and again, we'll talk about these things later in the chapter, later in the course, there is $1,564 million left to pay the other expenses of the company. If you look down here in the end, there's $213 million is the net income from recurring operations. And we'll see as we go through here, there are extraordinary things we need to account for. We can talk about earnings per share, dividends per share. As the course progresses, we'll talk about all of these things. The statement of cash flows is a very important statement in that it talks about where the cash inflows and outflows are actually going. In fact, it even reflects a very detailed view of the decisions that management makes. Essentially, management thinks about three things. They think about operations. So there is a cash flow from operations that talks about the cash that's generated from doing the business of the company. Financing activities reflect where did the cash come from or go to through financing the company. Well, financing either has to do with debt or it has to do with equity. So this just talks about the inflows and outflows of cash from debt and equity. Investing activities talk about the buying and selling of assets that are not for sale but are part of the assets of the company. Plant and equipment, for instance. Or it could even include assets that are purchased or securities that are purchased of other companies. So now we have a statement of cash flows. And this is just an excerpt, right? But here we have the net cash from operating activities. We have net cash from investing. We have the net cash from financing. And if you look across the board, sometimes this number, the net change in cash, is negative. Sometimes it's positive. Of course, we like it to be positive more than negative. But in general, what negative might mean is that this company is in the game of expanding. It's in the game of paying down its debt. And if you look here, the net cash from investing is negative 269, which means they've bought more assets than they've sold. And if you look at cash here, it means what? That it's negative, which means they've paid out more cash than they've brought in. So again, we end up with a negative 124 here. Again, we can now get a picture of how this company is making its decisions. Where are the big changes in cash occurring? Now, there's also, in an annual statement, that are what are referred to as the notes. We need to know how the statements were created. What are the accounting policies of the company? And this is a very important piece, if you will, of every annual report. If you want to know how they calculated the debt structure, how they reported long-term debt, you need to find that in the notes. If you want to know how the company is accounting for inventory, you need to find the inventory financial notes. In every annual report, one of the things we're going to want to see is the auditor's report. This is an independent or an external auditor. Their job is to attest to the fairness of the presentation of the financial statements. I'm sure you've heard of the Sarbanes-Oxley Act, but essentially what this act does is puts some more control on, or more emphasis, if you will, on the quality of the financial statements so that we can count on and rely on the information more. So it's an internal control kind of a piece. It asks for management's assessment of internal control. So the Sarbanes-Oxley Act is very important in understanding how transparency is created and how reliable financial statements ultimately will be. So there's a video here, obviously, that talks about auditors. Again, you can follow and watch through that video if you'd like. We're not going to spend a great deal of time talking about that or going through the video at this point. Maybe in class you can do this, or you can do it on your own. The auditor's report, though, really has, there's only 4 answers that they can provide. An unqualified report basically states that the information is provided in conformity with GAAP. That is, they couldn't find anything wrong. That doesn't mean that the statements are accurate. It means they could not find anything that's wrong. A qualified report would say, we think the statements are in conformity with the exception of, and then they will state why that information is not deemed as necessarily being in conformity. So if they find some peculiarities, you can still get a qualified report. However, that is now a heads up to investors. It's a heads up to regulators of what's going on inside the company. An adverse opinion means that the statements are not in accordance with GAAP. They haven't been done the right way. And a disclaimer basically says the auditor, for some reason or another, is not able to evaluate the fairness of the statements. So they're expressing no opinion. This might happen if halfway through the audit, the auditor decides they no longer want to work with this company. Or if the company fires the auditor, they will provide this type of a disclaimer of opinion. We could get what's referred to as an unqualified opinion with some explanatory language. Again, they would just add some more paragraphs to the report that just show, look, there were some changes in accounting principles. There's some uncertainty about future events maybe. There are certain events that may have arisen that provide some business risk or some ongoing concern issues, right? So it's just a variation, if you will, of one of the four primary auditor reports. A section of every annual report that I think is more important, quite frankly, than even the financial notes is what's referred to as the management discussion and analysis. Essentially, this is where management is going to tell us what happened and, in their opinion, why it happened. So this is going to look at favorable and unfavorable things. It's going to provide information that you can't find in the financial data. So it's going to talk about external and internal sources of liquidity. It's going to look for deficiencies. Talk about commitments that the company has made. Anticipating any changes that they think might happen in how they finance. Unusual events or transactions, right? So they're going to talk about a variety of things that, in their opinion, has created the picture that the financial statements represent. Companies do a good job of describing the historical events, but it's very difficult for them to provide accuracy and meaningful forecasts of the future. So explanations about why changes have happened are probably helpful, but the company and its explanation of what this might mean moving forward, again, now we're talking about uncertainty. We're talking about them predicting what this means. There's a section that's referred to as 5-year summary of selected financial data. This is going to look at some very specific pieces of the company, pieces of information that maybe you don't want to scour through all of the financial statements. These are the things that are perceived as being some of the most important data. And it looks, again, over a 5-year period. Sometimes you might find them even a little bit longer, but 5 years is primarily the time frame that we look at. One of the overall challenges with financial statements and analyzing a company is that sometimes there's just data that's not there. Sometimes the data isn't possible, right? How do you evaluate or quantify employee relations or the morale of employees, the reputation of the company, right? These are all opinions, if you will. They don't come from financial statements. So they're very difficult for us to get a total financial analysis of a company from the financial statements. It requires some business experience to understand how these things all fit together. How are these things publicly presented, right? How data is presented obviously affects public perception. That can have an impact on the market value of the company and its financial performance. So presenting this data is very, very important. Sometimes companies have several lines of unrelated businesses. We really want to find out what is that breakdown. Sometimes it's very difficult to find in the financial statements themselves, but in the management's discussion, they're going to present this breakdown so that we can understand how the company is performing within individual segments. So what is the future of financial statements, right? FASB tends to be very detailed. The international group is using some broader principles, right? We're trying to work together to create one set of standards. And while there is activity in this area, there are a wide variety of business strategies, if you will, that in different countries, things work a little bit differently. So in the end, what we would hope that is eventually there'll be one set of accounting standards for the world. So it wouldn't matter whether you're looking at a financial statement in China or the United States or in Colombia. All of those financial statements could be read and could be evaluated within the same guidelines, if you will, across the world. What we're ultimately hoping for is quality, right? So what does quality of information mean? Essentially what it means is you can count on the data. It is reliable. One of the biggest issues of having challenges with this reliability and having differences across countries has to do with the concept of matching. The matching principle basically says we want to match the expenses of the company with the revenues to determine net income. So what happens is when you buy an asset today, you spend money today. However, that asset might produce revenue for several years down the road. So matching involves some judgments regarding that timing. Should we spread the costs out over 5 years or 10 years? Or maybe it should only be 2 years. Maybe we should just write it off and not worry about matching to future events. So the more conservative we can be with this matching principle, the higher the quality the earnings might be. So again, there are many questions within financial statements. Over the next couple of chapters, we're going to look at one statement at a time, and we'll review its contents. We'll talk about what the parts of the statements mean, and we'll hopefully have a better understanding of what it is we read when we look at the annual report of a company.